The next topic we need to discuss are these additional South Carolina statutes and topics. Yeah, and this is sort of the catch-all chapter for the state-specific portion. Just meaning there's quite a few different things you need to understand when practicing real estate. So might feel like we're kind of jumping around a good bit from one topic or subject matter to another subject matter, and that's exactly what we're going to be doing in this chapter. But y'all, let's take a look. Y'all, you see some of the things we're going to be talking about. Obviously, a lot of completely different things that we're going to be spending time on. But things you need to understand if you're going to be practicing real estate. So let's start with this Consumer Protection Code. Obviously, this is the South Carolina Consumer Protection Code. And what you're looking at here are a few things, actually 4 things, that we've extracted from the code, because that's a very large document. But we just pulled out anything in that code that has anything to do with real estate. And that's what you see here on the slide and in your material as well. But number 1, according to the Consumer Protection Code, there is no maximum rate of interest that can be charged in South Carolina. If you recall back when we talked in the finance chapter, we talked about a law that some states have passed, right, that would limit or cap how much interest you could charge, right? So, but we're not one of those states. We have not passed any laws that caps the interest rate. So now the assumption is if you're going to loan money, and assuming it's in writing, whatever the parties agree to is fine, at least in terms of the law in South Carolina. But if you do not have it in writing, then there is a maximum amount of interest that can be charged, and that's 6%. You might want to remember that. Again, as long as it's in writing, there is no maximum amount of interest that can be charged or agreed upon. But if you're not going to have it in writing, just an oral agreement, or you're just shaking hands, then the most interest you can charge is 6%. Okay? And then number 2 says the borrower gets to select their attorney and their insurance agent. We've already talked about this a little bit, where we know the borrower, which would be the buyer. It's always the buyer's right to choose any service provider. Now here it's just talking about the attorney and the insurance agent. But there are other laws that basically say it's buyer's right to choose any provider they want. It's totally up to the buyer. But again, in the Consumer Protection Code, it only identifies 2 service providers according to this law. And what you might want to be careful with here, I don't know that they'll try to do this to you on the exam, but I don't know that they won't, so I just want to be safe than sorry. But they might ask you which of the following service providers are allowed to be chosen by the buyer according to the Consumer Protection Code. Well, if you look at the 4 options in the multiple choice question, you might think, well, again, the buyer has the right to choose any of these, and they do. But only 2 of them have been specifically identified in the Consumer Protection Code. And again, that's the attorney and their insurance agent. So, in case they just, if they say according to the Consumer Protection Code, then, these are the only 2 that are identified, okay? And then the third thing is dealing with loan transfer fees. Talking about like loan assumptions. We talked about loan assumptions in the finance chapter as well. But if you're going to assume someone else's loan, you're going to buy their house and assume their loan, well, then the fee to transfer that loan, it says, would be $400. or 1% of the unpaid balance, whichever is less. Now, y'all, that's kind of interesting because typically you would think they would say whichever is more, but y'all, it's whichever is less. So right away we know the most this fee could cost would be $400. That's the most it would be, or 1% of the unpaid balance. Y'all, in case they ask you a question here, y'all, let me make sure we understand something. Y'all, that 1% is based on the unpaid balance. Okay? You know, you might agree to pay $200,000 for the house, but the part or the loan that you're assuming from the seller might only be $150,000. That means you got to come up with another $50,000 to make up the $200,000. But y'all, you're only assuming a $150,000 balance. So the 1% should be 1% of the $150,000, not the purchase price of $200,000. So just beware of that. And then once you know what 1% of that unpaid balance is that more or less than $400? And then whichever is the lower amount, y'all, that's going to be the answer that they're going to be looking for. And then number 4, y'all, you see this conditions for prepayment penalties. Again, talked about this. In fact, all of this we talked about in the finance chapter. But y'all, we know a prepayment penalty is a provision that some lenders will put in your loan. Basically saying, if you pay your loan off early, y'all, you're gonna have to pay a penalty. Y'all, it's usually a few $1,000s. Y'all, it's not cheap. Y'all, this is a pretty significant penalty just to pay the loan off early. Y'all, that's ridiculous. But anyway, I would remember this, at least in South Carolina, lenders cannot charge a prepayment penalty if the loan amount is $180,000 or less. No loans can they charge this penalty for $180,000 or less. So obviously anything over $180,000, y'all, potentially they could insert this prepayment penalty. But now, if you recall, this is kind of a review, but y'all, in the finance chapter, we talked, y'all, there are certain types of loans that will not allow a prepayment penalty either. Y'all, just for example, VA. Y'all, if it's a VA loan, regardless of the loan amount, y'all, the VA will not allow a prepayment penalty. Okay? So, if they asking you a question, y'all, they may be asking you for this dollar amount of $180,000, but y'all, sometimes they might be just asking what type loan would be exempt from prepayment penalty, and then you'll notice $180,000 less is not an option. Then they're probably looking for VA, to be honest with you. All right, let's move on. That's the Consumer Protection Code. The next topic we look at is the Homestead exemption. Y'all, and again, now this is the South Carolina homestead exemption. Y'all, I'm sure other states have some form of homestead exemption. Some may be similar to this. Some might be just like this. But a lot of them are not. So just keep in mind, this is just for South Carolina. But for those that qualify for this exemption, the homestead, y'all, that means you get to deduct $50,000 from your property's market value before your property taxes are calculated. So if your house is valued at $200,000, and assuming you qualify for this exemption, you deduct $50,000 from the $200,000, and then so you're only going to be taxed on the $150,000. Y'all, that's a lot. That's a pretty significant savings there. Now, who qualifies for this exemption? Well, you got to meet one of 3 criteria. Either you have to be 65 years of age, or legally blind, or totally disabled. And then obviously you do have to be a legal resident of South Carolina for at least 1 year as of December 31st. But if anybody that meets any one of those 3, y'all, would qualify for this exemption. Now, we'll tell you, just for example, just because you might be, or maybe you know somebody, parents that might be 65 years of age or older, y'all make sure they've applied for this. Y'all, the state's not going to run anybody down trying to save them this tax money. You have to apply for it. There's not much to it. Y'all, it's an application you got to submit. Again, it's not much to the application, but you still got to submit that piece of paper, or you're not going to get the exemption. So just keep that in mind. But I remember that, y'all, they'll probably ask you questions about it. In fact, I will just tell you, there are a lot of homeowners in South Carolina because of this law, this exemption. Y'all, they don't have to pay any property taxes because their property may not be worth more than $50,000. It's only worth $50,000 or maybe a little less. Then obviously they would owe zero in property taxes if they, assuming they qualify for this exemption. All right, so that's the homestead. But now we get into the assessment rates in South Carolina. Now again, in the national portion of the exam, a much earlier chapter, we went over and talked about how property taxes are calculated from a national perspective, okay? All states tax property, real estate, pretty much the same way, except for the assessment rate. And obviously the assessment rate that each state would charge will determine how much or how little you have to pay in property taxes for that state. So what we're looking at right now, because we did not go over this in the national portion because it only applies to South Carolina, what are the assessment rates in South Carolina? Well, first of all, there are several different rates, depending on the type of property and the use of the property would determine what the assessment rate would be. But there's only two that you need to be concerned about for this class and for test purposes. So that's what we're looking at right here. And what you're seeing, if it's an owner-occupied residence, then the assessment rate would be 4%. You need to remember this, by the way. This is a memory item. And then any other property you own will be assessed at the 6% rate. Now, you'll notice, and it says right here, you can only have one piece of property that will be assessed at the 4% rate. Only one. Anything else, if you own multiple properties, then you're going to have to pay the 6% rate on those properties, on all other properties. In fact, I'll also tell you, I'm not sure if it says it right here in your book or not. You'll see it later if it doesn't. But, this 4% rate only applies for up to 5 acres of land, too. So as long as it's a owner occupied, you actually live on or in this property, up to 5 acres, you're going to be assessed at the 4% rate. If you happen to live in the property and it's more than 5 acres, anything over 5 acres is going to be assessed at the 6% rate. Now, looking at the 4% versus 6%, you might think that's probably not that big a deal. Obviously, 6% is going to be more, but it doesn't look like it's that big a deal. I'm telling you, it's a big deal. By the time all the numbers are actually worked out, if your taxes were, say, $1,000 a year at the 4% rate, you're probably, if they were to assess that at the 6% rate, you're probably looking closer to $2,500 to $3,000 a year. So it's almost, or right at 3 times the amount or difference between 4% and 6%, after all the math has been calculated. It's a huge difference. So obviously, anybody owning real estate is going to want the 4% rather than the 6%. But again, you can only get the 4% on one property. And you don't get to pick and choose which, if you have multiple properties, you don't get to pick and choose which one you want the 4% rate on. The law says you can only get 4% rate on the property that you currently occupy, that you live in. That's the only one you can claim as 4%. Now here's something also interesting about these assessment rates. And I would keep this in mind, not only for test purposes, but especially when you get out there and start practicing. When someone buys a house in South Carolina, the state assumes you will not be living here. That's the default the state will take. Meaning, guess what your assessment rate's going to be when you buy it? 6%. Again, that means you're paying approximately 3 times more taxes than what you should be charging, or paying rather, if it were at the 4% rate. So, all that to say this, when you buy property or real estate, then, within a few weeks, usually you want to give it 3-4 weeks, a month or so. You can't do it right after you buy it. You got to make sure everything gets recorded. There's proof that you own the property and stuff. So give it a little bit of time to get everything recorded properly. But then there's another application you got to send in to the assessor, basically saying that I live in this property and I want to be taxed at the 4% rate. Then they'll change it from 6% to 4%. But if you forget or you don't submit that application to change the assessment rate to 4%, you're going to be awfully shocked when you see your tax bill at the end of the year. It's going to be very expensive. So how do these taxes work? How do we calculate these taxes, if you remember? First of all, if you forgot from the much earlier chapter in the national portion, there is a formula here. It's a 2-step formula. And you will get some math questions. At least one, if not 2 math questions on the exam where you've got to figure out the property tax, okay? Well, if you'll memorize this formula, it's a 2-step formula, then you should have no problem figuring out what the taxes are or whatever the question they're asking you. The first part of it, the appraised value, or sometimes they may call it market value, times the assessment rate. That's at least in South Carolina, we know that's either 4% or 6%, right? So depending on what type of property they say, if they say it's owner-occupied property in the question, then we know the assessment rate is going to be 4%. If it says it's an investment property or rental property or any property that's not occupied by the owner, then we know that the assessment rate is going to be 6%. So all you do here is you take the value of the home times the rate, either 4% or 6%, and that will give you the assessed value of the property. Now, once you have the assessed value, then the next step is now you take that assessed value times the millage or millage rate, and that will tell you what your taxes will be. If you don't remember about millage and how all that works, again, that was in a earlier chapter. You might want to go back to that chapter and review over that. But look, if you memorize this formula, you should have no problems, none. Okay, because obviously, if you know any 2 of those 3 components, then you should be able to figure out the third based on this formula, right? And that's all you do. In fact, one of the things I've always done when I take the test, I actually write out this formula. I just write it out. So I'm not just trying to think about it in my mind. I write it on a piece of paper, and then I extract the information they give you in the question and fill in these blanks. And again, they have to give you enough information to at least fill out at least two of those three components. So yeah, it shouldn't be that big a deal. But let's look at an example of how this would work. Y'all, given that formula, here it says the market value is $125,000. Says the assessment rate is 4%, so we know that's owner occupied. So $125,000 times 4% would be a $5,000 assessed value. Then remember, to figure out your taxes, you take your assessed value times the millage rate, and we just give you an example of a millage rate here, 0.1760, and then we know the taxes on this property would be $880,000, or good grief, Frankie, $880 would be the taxes on that property. Hopefully that makes sense to you. If you need to, go back to the chapter where we actually discussed how all these property taxes are calculated. The only thing we're trying to get you to see here is when it comes to what the assessment rate will be. In South Carolina, it's either going to be 4% or 6%, depending on how you're using the property. Okay. But that's the only thing we're trying to get you to see here is just what are the assessment rates in South Carolina. The next thing we need to take a look at is this reassessment at time of sale, or what is commonly referred to as point of sale. A few years ago, I want to say, I think it was in 2006. Not that the date is that important. Don't worry about that, but just giving you some perspective. Prior to 2006, the way the county or the assessor determined your property taxes was a lot different than the way it is today. In fact, I will tell you, prior to 2006, you would have, if it had on your property tax bill, maybe they valued your house at $200,000. We all knew that was way less than what it was actually worth. In fact, if the assessor had you at $200,000, it was probably worth $250,000, $260,000, maybe $270,000, something like that. Which was actually a good thing, because obviously the lower the value the assessor gives you, the cheaper your taxes are going to be. But it was always way lower than what the value actually was. Well, in 2006, actually I think it went into effect January of 2007, if I'm not mistaken, because I think it was 2006 was an election year. And the reason that matters because they actually put this on the ballot in 2006 for the entire state to vote on. And basically they were saying, do you want to stay under the current tax system, or do we want to change and go to what we now know as point of sale? Sometimes you'll hear it called reassessment at time of sale, but it's commonly called point of sale. And there were so many, anytime you turn your TV on back then, it just seemed like every other commercial was dealing with this point of sale, where basically the legislature was advertising, trying to promote this point of sale, letting everybody know how awesome this new system would be. And obviously the only way you're going to get anybody to vote for it, they told us this was going to save everybody money on property taxes. Everybody's property tax would wind up being less if we convert over to this point of sale system. Obviously everybody's in favor of that. So it passed overwhelmingly. Like 95% of the state or something like that voted, yep, let's go to the point of sale. It didn't take long to figure out we'd been bamboozled again. Y'all, taxes did not go down. In fact, almost in most cases, taxes went up, way up, because here's what the point of sale did. Y'all, now, or at this point, y'all, once point of sale went into effect, y'all, the market value, appraised value of the property is now determined by whatever you paid for the house when you bought it. So if you bought it for $250,000, that's the appraised value we're going to use for tax purposes. Y'all, that's what's called point of sale. What did you pay at the time of sale? That's the value. Again, if you remember in the old system, it was going to be way less than that. They always were way up, tens of thousands of dollars less than what it was actually worth. Y'all, so if you think, y'all, how can anybody think that's going to make my taxes go down if this point of sale actually raises the market value by the assessor? Insane. But y'all, that's what point of sale is. That's all. That's the only thing we're trying to get you to see and understand, is that y'all, market value is based on the purchase price at the time the property was sold. That's how we now determine it. Okay? All right. Y'all, the next thing you see here, y'all still dealing with some taxes, is this thing called rollback taxes. Now, y'all, this is something that you want to really be careful with. You better pay attention to this as a real estate agent. It's important for test purposes, but y'all, if you're not paying attention here and when you're practicing real estate, y'all, you could really cause a lot of financial damage, hardship to buyers and or sellers. So beware of what we're getting ready to talk about now. If you recall, I was just saying a few minutes ago, y'all talking about the assessment rates. Y'all, the difference between 4% and 6%. Y'all, I'm telling you, that's a lot of money difference between 4 and 6%. So obviously anybody in the right mind would prefer the 4% rate. Well, remember, you can only get the 4% rate on owner-occupied property up to 5 acres of land, right? Y'all, if anybody owns more than 5 acres, y'all, anything over that's going to be assessed at the 6% rate. Y'all, that means you're going to be paying a lot more taxes on that property. So what a lot of people will do, and this is, y'all, there's nothing wrong with this, y'all, it's legal, y'all, the county will allow it. But y'all, let's say I actually own 10 acres or 20 acres. Y'all, obviously more than 5 acres. Y'all, that additional acreage, I could go to the assessor and tell them I want this property, this additional property, to be classified as agricultural property. Now look, if you're going to claim this property is to be classified as agricultural, then y'all, you got to be using it for agricultural purposes. That means you got to be growing something, right? Y'all, whether it be timber, which, and I will tell you, is what most people probably do. Y'all, if they need to, y'all, they'll go plant little pine seedlings all over the property and say, well, I'm growing timber. Well, that's considered agriculture. But it doesn't have to be timber. Y'all, it could be crops of some sort. But as long as you're using it for agricultural purposes, then you could actually get the whole property classified as agricultural. Well, if it's classified agricultural, then the assessor does not consider agriculture to be the highest and best use of the property. Therefore, they will allow you to pay the lower rate, in this case 4%, versus the 6%. So in essence, most people, I mean almost everybody that owns more than 5 acres, y'all, they will have the additional acreage classified as agricultural to bring the 6% rate down to the 4% rate for all of the property. Y'all, and that's legal. Y'all, there's nothing wrong with that. But here's where you better be paying attention. Y'all, if that property is classified as agricultural, and then the owner of that property ever changes the use of the property, y'all, they do something else with it. Maybe they decide, Susie's coming home from college and we don't want Susie moving back home with us, so we're going to put a house back here on the back 40 for Susie to live in. You just changed the use, right? That's no longer, at least that area is no longer being used for agriculture. You put a house there. You're now living there. That's no longer agricultural. So if you do anything with that property that would change the use, now you're going to be liable for rollback taxes. And I will tell you, these rollback taxes will be a little bit shocking to you. Because basically what they're going to do is this. In fact, I think I need to change the slide. Y'all, now the county will go back and determine how much would the taxes have been, or what would have been the difference in taxes between the 4% rate and the 6% rate over the last 3 years. And whatever that difference is, that's what you're going to owe in rollback taxes. Y'all, I'm telling you, that's going to be expensive. More than likely, that's going to be a very expensive tax bill you get. Y'all, if you think the 6% rate is high, again, you got to figure it's roughly pretty close to about 3% difference, or not 3%, 3 times the difference between 4% and 6%. So you got to pay that 3 times difference per year for 3 years in rollback taxes. And I'm just telling you, that's going to be a very costly bill you're going to now have to pay. Now here's what you got to be careful about. Obviously, if you're representing a buyer, and obviously, what type of property could rollback taxes affect? Anything over 5 acres of land. So if you're working with a buyer and they're buying real estate and it's more than 5 acres, you better go look and see, is any of that acreage classified as agricultural at the present time? And if it is, then you better make sure your buyer knows that. And you also want to make sure that, or ask them, are you planning on using it for any other reason? Because if they got other plans for this property and it's not agricultural, they're going to have to pay rollback taxes when they buy that property and change the use. And I get this all the time. Wait a minute, so you're telling me if I buy this property and decide to do something else with it, and I've only owned it for a couple of months, that I'm going to have to pay 3 years worth of rollback taxes? That's exactly what I'm saying. It does not matter how long the current owner owned the property. Whoever changed the use of the property is going to have to pay 3 years of rollback taxes. You better make sure your buyer knows that, and they better take that into account when they're negotiating sales price and whatnot. Because I'm just telling you, when they find out, or God forbid, they never even know, you don't tell them about rollback taxes and they don't know about it, and they go ahead and think they can do whatever they want to with that property because it's mine, I own it, and now all of a sudden they get a tax bill for $10,000, $15,000, $20,000, whatever it comes out to be. And if they can't pay it, the county's going to take the property from them. They're going to take it for not paying the taxes. And they can sit there and say, well, I didn't know anything about these taxes or what. I'm just telling you, ignorance of the law is no excuse. And I promise you, they're not going to be happy with you. They're going to come back and want to talk to you for sure. Now, having said all that, y'all, hopefully you understand what rollback taxes are. Y'all, there are potentially some ways to avoid having to pay these taxes. Maybe you can go talk to the assessor before you change the use. I'm just telling you, it ain't gonna work for you to do something or change the use and then ask for forgiveness later. That ain't gonna work. But maybe if you were to go sit down with the assessor and talk to them about what you would like to do, maybe there's a way they can try to maybe not charge the full amount of rollback taxes, or in some way exempt you from having to pay it at all. But y'all, I have known people that have been successful in either negotiating the rollback taxes away, where they don't have to pay any at all, or at least had it reduced quite substantially. But I'm just telling you, y'all, if you go ahead and change the use and then try to negotiate this, you're not going to win. Y'all, once you change the use, the assessor's going to bill you for the full amount, and you better pay up. That's all there is to it. All right. And then the last of the tax information you need to be familiar with is something called a 7% non-resident sales tax. And it's pretty much what it sounds like. This is a tax that's only charged to a seller that is selling property in South Carolina but does not live in South Carolina. They're considered a non-resident. Maybe they live in Georgia. They're a resident of Georgia. They just happen to own property in South Carolina. Well, when you sell property in South Carolina as a non-resident, then you are potentially subject to a 7% sales tax on the gain of that property. And again, so it's not necessarily 7% of the sales price, it's 7% of the gain. Remember we did talk about capital gains a little bit in an earlier chapter. But whatever your gain on that, the money you make on that property, on the sale of that property, you may have to pay a 7% tax on that gain. Now, obviously, if you ever list property for sale and your seller does not live in South Carolina, you better make them aware of this tax. Again, when they go to sell the property and then they find out at closing, because this tax is going to be deducted from their proceeds at closing. And if there's not enough proceeds from the sale to pay this tax, seller, you're going to have to come to closing and write a check. And I'm just telling you, if that happens and you never disclose this information to the seller, again, they're not going to be happy with you. You might be writing part or all of that check at some point. So, look, and it says here as well, but I'm assuming most of you are not accountants or CPAs, and even if you are a CPA, you might not be that familiar with this particular law. My point is, don't be trying to give tax advice. Don't do that. Certainly don't try to calculate how much this tax is going to be if they sell the property. Just let your seller know that because you do not live in South Carolina does have a 7% non-resident sales tax that could apply to this transaction if you're going to sell the property. Before we put this property on the market, I highly recommend go get this or go talk to an accountant or tax advisor, whoever you work with, and get advice from them and find out exactly what this is and how it's going to work and how it will affect you when you sell. I can't give you that advice. I'm not going to. I just want you to be aware of it so you can go find out for yourself if this is still something you want to do. I've actually had a couple of clients that after talking to their accountant and they found out how much this tax was going to be, both of them actually said, well, I can't sell it. I can't pay the tax. I'm just not going to be able to do it. And I will tell you where you see these kind of deals mostly, at least I have, is when say mom or dad passes away and leaves the house to one of their kids or all their kids, and their kids don't live in South Carolina, so they just want to sell the house and just get the money out of it. Well, there are some things you need to be doing, with probate. And again, I'm not going to get into all the details. I'm not going to get into the weeds here. But if you don't do take the proper steps, you might want to let me just say this. You might want to get the property appraised at the time of death. Okay? Otherwise, and I'm trying to be careful about how much I say here because I don't want to overspeak, but you need to get the property appraised. If you don't do that, then the state could, not saying they would, but the state could say, well, you didn't pay anything for this property. It was a gift. So basically you paid nothing. You're selling it for $200,000. Then that's a $200,000 capital gain to you. So now you owe a 7% tax on that sale. Anyway, I'm probably saying more than I probably need to say right now. So let me kind of backtrack a little bit. Again, just make sure if the seller does not live in South Carolina, they get some very good tax advice, accounting advice, before you put the property on the market, because I'm telling you, they may not be able to sell the property when they see what the taxes are going to be. So just be careful with this. Now I will tell you, I've also had other clients, again, I'm not an accountant, so I don't know how this works, but apparently their accountant was able to get them basically exempt from having to pay this non-resident tax. So there may be a way to avoid having to pay it at all. So again, that's why your client needs to talk to an accountant. Don't you start trying to give them tax advice here. And they may try to ask you something on the exam to make sure you should never be given tax advice, legal advice, or anything of that nature. You just make a recommendation. You probably need to talk to an accountant about that, and that's as far as you need to go. And then let them handle it. All right, so that's what you need to know for property tax wise, at least according to the South Carolina statutes. Okay.